The IRS just quietly split American workers into groups, and if you were born between 1955 and 1975, the new August rules could change how much money you actually keep. Stop whatever you are doing. Because what we are about to walk through affects millions of people right now, and most of them have absolutely no idea it is happening. The IRS does not send you a personal letter when the rules shift. They update a document buried in a government database, and they expect you to find it yourself. Well, today, you are finding it. Here is what you need to understand right away. The federal government has grouped workers by birth year. Not by income. Not by job title. By the year you were born. And the group you fall into determines exactly how a new set of withholding and retirement distribution rules will hit your paycheck and your savings starting this August. We are going to walk through every group: people born in the 1950s and early 1960s, people born in the mid-1960s through early 1970s, and people born after 1973. Each group faces something different. Each group has a deadline. And for at least one of those groups, doing nothing before August could mean losing hundreds of dollars you should have kept. Stay with me. Because the group most people underestimate is the one that gets hit the hardest, and we will get to exactly which birth years that covers in just a moment. But first, let us establish exactly who is doing this and why, because that context is going to make everything else click. The Internal Revenue Service revised its withholding guidance tables this year. That sounds boring. It is not boring. Withholding tables are the hidden machinery that decide how much federal tax your employer pulls from your check before you ever see it. Or, if you are already drawing from a 401k, an IRA, or a pension, they determine how much gets skimmed off the top of every single distribution you take. When those tables shift, and you have not updated your W-4 or your W-4P form, you are operating on old numbers. Old numbers in a new system. And the gap between those two things either means you are overpaying and giving the government an interest-free loan all year, or you are underpaying and walking toward a tax bill in April that is going to feel like a punch you never saw coming. Neither of those outcomes is good. Both of them are avoidable. And the way you avoid them depends entirely on which birth year group you are in. Now let us talk about the groups. If you were born between 1955 and 1964, pay very close attention to what comes next. This is the group that sits at the most complicated intersection of the new rules. Here is why. People in this birth range are either approaching retirement, already in early retirement, or actively drawing from retirement accounts while possibly still earning some income. That combination, part employment income, part distribution income, creates a withholding situation that the old tables handled one way and the new tables handle a completely different way. The revised guidance now treats blended income differently. If you have a pension and a part-time job, or an IRA distribution and some freelance income, the way those two streams interact under withholding has changed. The IRS updated the calculation methodology this year, and the threshold at which you move into a higher effective withholding rate has shifted. What that means practically, and this is the part that matters, is that some people in this birth range who have not updated their withholding elections are now technically underwithheld. They do not feel it today. They will feel it in April. The estimated gap for someone with a modest blended income sits somewhere between $300 and $800 in unexpected tax owed, depending on state and total income. If that sounds like it might be you, do not panic yet. There is a specific form and a specific field on that form that fixes this, and we are going to cover exactly what to do before we finish today. But first, if you are still watching and wondering whether this really applies to your situation, here is a quick way to know. Did you change jobs, retire, start drawing Social Security, or begin taking IRA distributions at any point in the last 18 months? If the answer is yes and you did not file a new W-4 or W-4P after that change, you are almost certainly running on outdated withholding instructions. That is not an opinion. That is how the system works. Okay. Let us move to the second group. If you were born between 1965 and 1973, you are in what tax professionals are quietly calling the transition window. You are too young to be drawing retirement distributions in most cases, but you are old enough that the new rules around catch-up contribution limits and withholding on employer-sponsored plans now apply to you in ways they did not before. Here is what changed specifically for this group. The IRS adjusted the income phase-out ranges for deductible IRA contributions this year. That means the income level at which your traditional IRA contribution stops being fully deductible has shifted. If you are in this birth range and you have been automatically contributing to a traditional IRA assuming full deductibility, and your income has grown in the last couple of years, you may now be in a partial or zero deductibility zone without realizing it. This matters because if you are contributing money to a traditional IRA thinking it is pre-tax and it is actually post-tax due to the phase-out, you are not just missing a deduction. You are also setting yourself up for potential double taxation on that money when you withdraw it later, unless you file the right documentation now to establish the basis. That documentation is a form called the 8606. Most people in this birth range have never heard of it. A lot of financial advisors forget to mention it. And the IRS is not going to remind you. But if this situation applies to you, that single form could protect thousands of dollars over the course of your retirement. We are going to come back to the 8606 and exactly when you need to file it. Hold that thought. Because right now we need to talk about the third group, and this is the group that has the most time but is making the most dangerous assumptions. If you were born after 1973, so you are in your late 40s or early 50s right now, you probably feel like retirement rules do not apply to you yet. That assumption is costing people in this group real money right now, not in 30 years, right now. Here is the specific August change that hits this group. The IRS updated its guidance on employer plan matching and the new Roth catch-up requirements that were part of the Secure 2.0 Act. Starting this year, employers with more than one employee, which is essentially every employer, are required to direct catch-up contributions for high earners into Roth accounts rather than traditional pre-tax accounts. The income threshold for who counts as a high earner for this purpose is $145,000 in FICA wages. If you earned above that number in the prior year, your catch-up contributions must go Roth. Full stop. No exceptions. If your payroll department has not updated your plan elections to reflect this, and many have not, because implementation has been chaotic, you may currently be having money directed into the wrong account type. Money that should be going into Roth is sitting in traditional. That creates a compliance issue that has to be corrected. And the correction process, if you do not catch it early, becomes significantly more painful and expensive the longer it sits. The window to address this cleanly, meaning with minimal paperwork and no penalties, is narrowest right now, before plans finalize their August reporting cycles. So if you are in this third group, your action is not about updating your W-4. Your action is about calling your HR or benefits department and asking one specific question. We are going to tell you exactly what that question is before this video ends. Now let us zoom out for a moment, because I want to connect these three groups to a single underlying reality that makes all of this feel less overwhelming. The reason the IRS changed these rules at this exact moment, with these exact thresholds, is that the overall demographic composition of the American workforce is shifting. The number of people simultaneously holding employment income and retirement distribution income is at a historic high. The number of people making catch-up contributions is growing every year as baby boomers and early Gen X workers hit peak saving years. And the old tax code infrastructure was not built to handle this volume of complexity. So the IRS updated the machinery. They recalibrated the tables, shifted the thresholds, and added new mandatory account type requirements. And then, as they always do, they moved on. They updated their publications. They posted the new tables. And they left it to every individual American worker to figure out whether their situation had changed and what to do about it. That is the system. That is how it works. And the people who get hurt are not the people who made bad decisions. They are the people who made no decision at all, who assumed that because nothing looked different on the surface, nothing had changed underneath. Something has changed. It changed earlier this year. The August cycle is when it starts showing up in the numbers. And now you know about it before it shows up in yours. Let us talk about what to actually do, and let us be specific, because vague advice is not useful to anyone. If you are in the first group, born between 1955 and 1964, here is your immediate action. Go to irs.gov and download the tax withholding estimator tool. It is free. You input your income sources, employment, Social Security, pension, IRA distributions, everything, and it tells you exactly whether you are on track or under withheld for the year. If the estimator shows a gap, you update your W-4 or W-4P with your employer or plan administrator immediately. Do not wait until October to think about this. Doing it in the next 30 days keeps you ahead of the fourth quarter calculation cycle. If you are in the second group, born between 1965 and 1973, your first step is to pull your tax return from last year and find Schedule 1 and Form 8606 if it exists. If you contributed to a traditional IRA and your income was anywhere near the phase-out range, which for 2024 starts at $77,000 for single filers and $123,000 for married filing jointly, you need to sit down with a tax preparer or use qualified software and verify your deductibility status. If you are in the non-deductible zone, file the 8606 to establish your basis. This is not optional. This is protection. If you are in the third group, born after 1973 and earning above $145,000 in wages, here is the exact question you ask your HR department. You ask, has our plan been updated to route catch-up contributions for high earners into Roth accounts in compliance with the Secure 2.0 guidance? That is the question. If they hesitate, if they say they are not sure, if they tell you to check back later, you escalate. You ask for the plan administrator contact. You ask for written confirmation. Because if your contributions are in the wrong account type and you do not catch it, the correction falls on you. Now, here is something that applies to everyone watching regardless of which group you are in. The most dangerous financial position is the one where you assume someone else is tracking this for you. Your employer is not tracking this for you. Your plan administrator is not proactively reaching out. Your bank is not monitoring your withholding elections. The IRS is certainly not sending you a personal alert. The people who come out ahead in years when the rules change are the people who take 30 minutes, just 30 minutes, to verify that their current elections match the current rules. That is it. 30 minutes. For most people watching this right now, that 30 minutes is the difference between a surprise bill in April and a refund, or between a compliant retirement account and a compliance headache that takes months to untangle. You have that 30 minutes. You have more than that 30 minutes. You are watching this right now, which means you already started. Before we wrap up, let me re-emphasize the timeline pressure, because this is real and it matters. August is when quarterly plan reporting cycles close. August is when payroll systems lock in Q3 withholding adjustments. August is when the documentation trail for this tax year gets harder to amend cleanly. That does not mean it is impossible after August. It means it is easier, cleaner, and cheaper to address in the next few weeks than it will be to address in October or December or, worst case, in April. The window is open right now. And now you know exactly what to do with it. Here is your action checklist before you close this video. 1. Identify your birth year group using the ranges we covered. 2. Based on your group, take the one specific action assigned to that group. 3. If anything about your income situation changed in the last 18 months, run the IRS withholding estimator regardless of which group you are in. 4. If you have an IRA and any uncertainty about deductibility, look up your prior 8,606 filings. 5. If you are a high earner with access to a workplace plan, confirm your catch-up contributions are correctly classified. 5 steps. Not complicated. Just necessary. If this video helped you understand something that your employer, your bank, and the IRS were never going to explain to you clearly, share it with someone else in your birth year range. Because the same rules apply to them, and there is a very high chance they do not know any of this yet. The system updates quietly. You just chose not to be quiet about it.